Unless you've been living under a rock, you're probably aware that over the past few months, the Federal Reserve has been printing significant quantities of money. In the end, this money printing has grown financial assets globally, leading to an unprecedented situation. Ray Dalio, the founder and chief investment officer of the largest hedge fund in the world, Bridgewater Associates, recently discussed how he believes the Federal Reserve has backed the financial markets into a corner. Dalio is an expert in macroeconomics, which has helped him successfully manage $150 billion over the past few decades. Because of his renowned expertise, countries have actually sought out Dalio for his economic insight. However, this isn't just a trap for the Federal Reserve. As some of you may already know, bond prices and bond yields are inversely related. When bond prices go up, bond yields must go down. And when bond yields go down, bond yields must go up. As a result, bond yields have been artificially inflated over the past few months due to the Federal Reserve's high levels of quantitative easing, or essentially the purchasing of massive amounts of bonds. He predicts that the federal government will soon be compelled to buy bonds rather than sell them, which, at first glance, may seem ridiculous, but makes a lot of sense given that bonds are currently not appealing. One of the reasons why bond prices are so high is that large institutions have piled up treasury bonds in an effort to be cautious, so that if the pandemic comes back into play, they can sell those bonds and support their businesses. Once these large institutions and investors start selling bonds to buy other financial assets, like domestic stocks, real estate, and international stocks, bond costs will plummet. No one wants to buy bonds when inflationary pressures are present because inflation guarantees negative real returns at the current rate. In addition, other financial assets have the potential to generate significantly higher returns. To prevent the selling power from leading to a crash in bond prices, the Fed will have to buy bonds, which artificially increases the money supply. So this will happen instead of tapering off as the Fed planned initially. This type of inflation is known as monetary inflation, which occurs when there is a consistent increase in the money supply. Although you might think that the Federal Reserve will let bonds crash, the bubble popping would significantly impact every other asset class. When interest rates are low, borrowing money pays off handsomely, which is not surprising since borrowing money is essentially free. The Federal Reserve wants interest rates to rise. Dalio mentioned how the Fed will need to buy bonds to prevent this from happening. Dalio believes that investors can make enormous profits before this event actually occurs by investing in Chinese-related assets. Now, the Fed can't just let interest rates rise, as that would cause an entire crash in all financial assets. In an effort to meet the high demand created by the pandemic, U.S. businesses have started importing an increasing amount of Chinese goods. This has resulted in an unequal balance of payments for both nations, as each country has a balance of payments that details all of its international transactions. The current account and the financial account are the two components of balance of payments. The current account includes all international trades in goods and services, as well as transfer payments, while the financial account also includes investments in foreign financial assets, like stocks. Because China has been exporting goods to the US recently, their current account isn't in surplus, meaning the Chinese businesses now have significant supply of US dollars. Dalio believes there is a bubble in US financial assets, which makes it challenging for investors to locate worthwhile investment opportunities because many stocks are trading at premium values. Former Treasury Secretary and current Harvard economics professor Larry Summers joins Dalio to discuss how the economy will likely change significantly in the future. Larry compared our predicament to driving a car at 100 miles per hour on a clear road, but since the road won't always be clear, if we don't slow down our car, we'll get into an accident along the way. The truth is that a crash may never occur. The only thing that is certain at this time is that lower long-term real returns in financial assets seem very likely. Over the past year, people have enjoyed outstanding capital gains, but don't expect these types of returns to continue for the general market. There will be some stocks that will rise significantly, but those types of opportunities will be much harder to find because when asset prices rise, the yield on those assets decline. Similar to how the predicted future rates of a term decline when the stock market rises, total financial assets in general will probably have lower long-term real returns. Thanks for tuning in to Finance Experts. We hope you found today's video helpful and informative. Don't forget to subscribe to our channel for more financial news, tips, and strategies. Thanks for watching, and we'll see you in the next video.